talk about a topic that I think isn't discussed enough, and it's unfortunately not going to have to do with any kind of chart, but I think, and I'm back with another video today where I wanted to talk about a topic that I think isn't discussed enough, and it's unfortunately not going to have to do with any kind of chart, but I think you'll walk away with a greater understanding of this topic and potentially how to trade it. So let's get into it right away and go to my handy notepad. And today we're talking about implied volatility, or IV. You may have heard this talked about, referenced, but you're wondering, hey, what the heck is implied volatility? Stick around. So by definition, implied volatility is the market's forecast of a likely movement in a stock's price, or an asset in a stock's price. It's technically asset, but who are we kidding? We're talking stocks here, right? So the key word here is movement. It predicts movement. Implied volatility predicts movement, not direction. So it's saying up or down, side to side. This stock, if it has implied volatility, is probably going to move a lot. So in general, when the market goes up, IV goes down, and when the market goes down, IV goes up. The Cboe Volatility Index, which is the ticker symbol VIX, I'll add it on there so you can see, also known as the fear gauge. It measures volatility and is based on S&P 500 option pricing. Look it up. I'll do another video on the VIX as well. I realize I might have just dunked a bunch of jargon on you. Stick around though. So as implied volatility increases, option prices rise. Now notice that is not talking about call option prices rising or put option prices rising. So it kind of is that a rising tide lifts all ships sort of thing. Ships with a P. I did not misspeak. And as implied volatility increases, option deltas approach 0.5. This is important. I covered deltas in a previous video on option Greeks, or the things that determine option pricing, to put in layman's terms. So you could check out that video below. I'll add a link to that. But as IV increases, option deltas approach 0.5. So longer dated and at the money options are most sensitive to changes in implied volatility. So short-term options really don't feel as much of a change in implied volatility as longer dated options do. So at the money options, so your more speculative bets aren't going to be affected as much by changes in implied volatility as at the money options. So let's keep going. So how to trade using implied volatility? What does this mean, right? So you told me a bunch of stuff. Implied volatility goes up and increase options prices. How can I capitalize on that? The first one is the most natural lesson in the stock market. Buy low and sell high, which sounds simple, but I'm not talking about necessarily stocks here or options themselves, which of course that is a, avenue to success of buying low and selling high. But when we're talking about implied volatility, you can try to capture the increase or decrease of implied volatility. So implied volatility really tends to rise ahead of earnings reports. Think about it. As the anticipation ahead of a company's earning report grows, people are going to start getting more and more excited about the potential upside or downside effects on the price that earnings report will have. So people start buying more options. The speculators start placing their bets. Option sellers trying to collect premium start placing their bets. And so you start seeing this flurry of option activity ahead of earnings, and that causes implied volatility to increase. There's opportunity just in that increase alone. It's possible to buy an option. Doesn't matter if it's a call or put, and ahead of earnings, and for the stock to trade relatively sideways or even slightly downward, and in that time frame, that option value that you purchased could increase based solely off an increase of implied volatility. Now, on the other side of the coin, IV falls sharply after earnings. This is a harsh reality many traders get introduced to when they buy an option ahead of earnings and hold it through earnings. Now, with the previous example, when you buy an option ahead of earnings and it kind of trades sideways, but the value goes up because implied volatility increases, provides an opportunity to sell the option, just capturing that volatility increase, sell it before earnings, and bingo bango, profitable trade, right? Buy low, sell high. Now, when it comes to implied volatility crush after a stock reports earnings, there's a couple caveats. Suppose you buy a slightly out of the money call option on a stock ahead of earnings. You're paying a high premium for that stock because anticipation is at its highest right before the stock reports. So implied volatility has risen, causing the price or cost of all options to increase. So you buy your slightly out of the money call option. The stock reports earnings, and the next day that trade goes in your favor. Now, like I said, it's out of the money call option. So you're taking a bit of a speculative bet. The next day, after a stock reports earning, IV falls sharply. Because of this, you can be directionally correct. Like I said, the stock goes up after, in this hypothetical scenario. You can be directionally correct, and your option that you bought will still go down in value because of the release of implied volatility. It's like all this anticipation builds up, and then, okay, we got there. That's an earnings report, IV crush in personified right there. That was terrible. I'm sorry. Please don't rewind to that part. All the other parts, yes, but that part, no. So yeah, that is the IV crush that can happen. Now, some traders look to capture this IV crush by selling options ahead of earnings and, that carry over through the earnings report. So this was just a quick breakdown on what IV is, a definition, what it does to options, and a little bit into how you could potentially trade it. I just wanted to introduce you guys to implied volatility and give you a little bit